There has been two constant themes impacting financial markets in the first half of 2022, inflation and also the direction of interest rates. At the end of June, US markets recorded their worst first half in more than 50 years. Why? Well, the Federal Reserve has attempted to curb persistent inflation, and this has led to concerns how this will then impact on global growth. So let's start by looking at growth assets. Well, the leading UK market was down by nearly 5% on the month. The US and European markets fell over 7%. So in terms of factor performance over the month, growth stocks were slightly ahead over value, and this reverses the trend we've seen for a lot of 2022. Higher interest rates mean that companies that are going to deliver cash to shareholders soon are more valuable than those whose returns are further in the future. And that's why value stocks have been making a comeback recently. So back to the inflation story. Well, part of the noise we're hearing at the moment is that the Fed kept with the mindset that it will be transitory. Meanwhile, in reality, the cost of living has been getting higher and higher each month. And this has been driven by supply chain problems. Put simply, demand overwhelmed shippers' ability to get products to market and has resulted in much higher prices. UK inflation edged to 9.1% in the year to May 2022. That's the highest level since 1982. Now, in reaction, the Bank of England raised the base rate to 1.25%, and more are expected to follow. US inflation, meanwhile, stands at 8.6%. Now, that's the highest figure since December 1981. And let's remember, both the Bank of England and the Fed have got inflation targets of just 2%. The impact of these two major themes has been continued volatility in growth assets. However, it's worth noting that a substantial proportion of the total return of stocks over long periods of investing is actually derived from just a handful of days in those periods. So the prudent course of action is to remain invested during periods of volatility rather than jump in and then out of the market. Otherwise, investors run the risk of being on the sidelines on the days when returns happen to be strongly positive. So let's look at an example. So in the first half of 1970, the leading US market fell by 21%. However, it promptly reversed those losses to gain 26.5% in the second half. So let's move now to defensive assets. So UK government and corporate bonds in the UK over the month faced potentially their worst month since 1995. Both the short and also the long end of the gilt market have seen a material rise in yields, whilst corporate bonds have been negatively affected by rising rates and also short-term risk aversion. So in summary, as we move into the second half of the year, the markets are likely to continue to face the same economic issues it did in the first half of 2022. As a result, volatility is likely to continue. However, what is key for investors in managing volatility remains a well-diversified portfolio.